Hello, Propenomix people, and welcome to another Sunday Supplement Live. This week's was called We Is Broke, innit? And it's best said in the dulcet tones of Sacha Baron Cohen playing his OG character Ali G. If you've not listened before, you'll not know, but I'd like to start every week with a quote. And this week's was, "There comes a time when one must take a position that is neither safe nor politic nor popular, but he must take it because conscience tells him it is right." And that was from Martin Luther King Jr. So that quote is about politics and courage, and you're going to see why in the deep dive. It's very contrasting to this week's title about "This Was Broke, We Is Broke, in it." But before we go into this week full hammer, Rod Turner and I will be running our next property business workshop on Wednesday, the 1st of October in London. The subject matter this time is investment, with an emphasis on what metrics you really need to be considering to run your property business properly and building your business to scale. How have we done so many deals? Well, we'll tell you. Book your super early bird tickets with 20% plus off the face sticker price of the tickets now at bit.ly/PBWEIGHT. Okay, onwards into Trumpwatch. Tariffs were front and centre as expected, given the 90-day expiry window, and June's tariff revenue in the US was $30 billion, which was 3 times the March figure. But if you look at the US figures, you'll know that they're spending about 7 trillion a year and bringing in about 5. So 30 billion, yeah, it's something. It's treble the March figure, as it says, but really it's still a bit of a pebble in a pond on that front. Canada was in the firing line this week with a 35% tariff, especially for them on their goods, with 15 to 20% being imposed on nations that have not secured a deal yet. The double down before the end of the expected extension, August the 1st, is the last extension. Honest. 60 countries to go. Can't see any problems there. Well, the markets really can't, or at least the stock market. The bond market is adjusted after the Fed's language was not congruent with the Trump administration's 3% cut in interest rates that it was suggesting. I just can't fathom what's going to happen next year when a Trump stooge is appointed as the Federal Reserve Chair. But next year is too far away for the markets to worry about at the moment, clearly. Then there's another reason for businesses to wait until any important decisions that are already deferred to July to August the 1st and beyond. Volatility remains the watchword depending on what deals are done. The dollar had a strong week, which we haven't been reporting on at all really this year, which has been lacking in the first half, as I've said. But is safe haven demand back yet? I'm not sure why it would be, to be honest. The colloquial call in the markets is the taco trade. Trump always chickens out. Not a bet I'd want to be making personally. I would prefer Tina. Trump is nutter always. Good luck predicting the Donald. The economic strategy overall, of course, may well be to weaken the dollar deliberately. It's certainly been working if it has been the plan, in order to rebalance some of the trade imbalances. It certainly isn't the sort of thing that Trump or any president really would ever come out and say, but it's better to let it happen and then blame someone else, even if it was what you wanted to achieve. Thankfully, the UK is outside of the tariff crosshairs at this time, which is why we haven't been hearing too much on this side of the pond. The short-term pain is the same, of course. Cost structures are increasing, as everyone said they would, meaning inflation on the good side of the equation. As so often in this section, watching Trump feels like watching an entertainer of average talent cross Niagara Falls on a tightrope. Compelling viewing, but not what you really want to be watching, just what you feel compelled to watch. Let's bring it back on shore then anyway, the real-time UK property market. Chris Watkin delivers again. Week 26 has now been reported on, halfway through the year. Listings printed 36.9k, no real change on 36.7k last week. Still 4.7% ahead of last year and 7.7% ahead of the pre-pandemic market. My 10% more stock than a normal market ready reckoner is still just about clinging on, but we're 14.5% ahead of the 9-year average, although I've said before that includes 2020, which I'm not deeply happy about because that kind of pollutes the figures somewhat. But anyway, we're limping around the mean for this time of year, not forging further forward into even more listings than historically precedent. 27,500 price reductions, 14.1% reduced in June compared to last year's 12.1. April's 13.4, and the 5-year average of 10.6. More stock, more reductions, absolutely and relatively. 33% more reductions than the 5-year average. That's the difference between 14.1 and 10.6. 25% more reduced properties than a normal market. Also works as a bit of a ready reckoner. Although we could say 33% now at this point in time, so 1 in 3. 1 in 7 properties on the market are being reduced each month. So we're running at a little over 100,000 price reductions per month, to be clear. Sitting out there saying you can't find a deal, look, keep the legwork up and you'll get there. 26,600 homes sold subject to contract, which is still healthy, up 7.7 year on year, 15.6 on the pre-pandemic market of 17 to 19, still nearly keeping pace with 2022, which up to this point was a very hot market indeed. We went into June with 756,675 homes on the market. I'm sure we'll have an updated July when we went into July figure next week. The market got stickier. Before the pandemic, it was 660,000. A seller's market would look more like 600,000 or fewer on the market. At the end of a year ago, 694,000 were on the market. So it's a pretty lumpy trend upwards in May. And with this amount of stock on the market, it's going to continually be hard for prices to be surging forward in the coming months. I've been talking about this flat feeling that's going to manifest itself in this steady market without much excitement as we head into summer proper. The first month which sees fewer on the market that isn't November or December would be a bit of a tell about this glut of stock, provided at least in part by existing landlords that never spoken about truth of the current market has reached its peak. But there's no guarantee that we're there yet. I'd suggest we're probably close, though. Fall-throughs are staying below their 7-year average, still 23.7% on last week's 23.2, still relatively normal noise. Net sales are playing ball, 6% up on last year, 11.1 higher than 17 to 19. So the net sales are not at the 2022 levels, but the stamp cliff will have pushed a few more transactions out of bed, of course. And then as the year progresses, assuming we're not having a big shock in H2 of this year, things are likely going to catch up because transactions are significantly disturbed by the 2022 budget and the bond markets, of course, in comparison. I always give Chris a weekly shout out here because he's much more prolific than just this epic tome he releases weekly on the UK property market. He comes up with great stats and graphics on a regular basis. If you'd be kind enough to drop him a like, drop him a subscribe and all the rest of it, and some kind words for his content creation, I'm sure he'd appreciate it, and so would I. So if you're in the industry and you want support in growing your business to be a more effective communicator or be more in touch with your local market, that's Chris's core business, so give him a shout. His article gets published on the Property Industry Eye website and the video on his YouTube channel, which is @ChristopherWatkin. Okay, here comes this week's macro drift as we head sideways once more, if not a little bit backwards. Halifax released their price index, which wasn't in line with Nationwide's last week, and the ripples that caused. We'll also look at Zoopla's price index report in the same segment. Then there was the RICS residential market report for June, which we're obligated to take a look at. And of course, we can't avoid GDP growth. Well, that's a bad choice of words, really, isn't it? Because it turns out that we can, but we better talk about it anyway. And then our ever-present gilts and swaps. So if you recall, last week's nationwide 0.8% month-on-month fall caused a bit of a stir, although Nationwide themselves in their report pretty much distanced themselves from that conclusion in their own index. It was the biggest fall since the last biggest fall, etc., etc., etc. The media jumped on the bandwagon. Those who spend their free time willing house prices down anyway, those who talk about the terrible lack of unaffordability without actually looking at any context or any real data or anything like that. I've discussed several times before now and have been having this discussion for years now. Prices are at an inflation-adjusted and wage-adjusted historical low for this generation. Let me say that again. Prices are at an inflation-adjusted and wage-adjusted historical low for this generation. I should make a further qualifying note here because you'll know if you've listened before, I like to strive for accuracy, not sound bites. And it's not to say, what I'm not saying there is the cost of living in a house is at the same generational low. Energy prices are up 50% in 5 years, but they're not a massive percentage of the cost of living in a house. The rent or the mortgage are, although there are, of course, 36% of households owning and living in an unencumbered property. And their two essentials, realistically, would be utilities and council tax. And almost certainly, utilities is the highest bill of those two, especially given what's happened in those past 5 years. Now, Halifax printed 0.0% growth for the month, but they did print a drop of 0.3% last month. Let's remember that. And they did also retreat a teeny tiny bit on their average price, but not enough for the rounding to get to even a 0.1% drop. This sees the annual house price growth of 2.5%, according to Halifax. So we're very much in a 2 to 2.5% pattern from the wider cited indices at this time. They also report first-time buyer numbers back to pre-stamp duty change levels, which is a nice stat for us to have in the books. And what it's saying is whatever transactions were front-loaded into Q1 of 2025 leveled out in Q2 and the seesaw balanced, and we're back to normal. Perfectly believable. The change was not that huge, only affecting first-time buyers buying at over 300k. And that probably encompasses about a quarter or so of first-time buyer properties around the UK. Average is about 225,000 for a first-time buyer property, according to the UK finance figures. I'm guessing at the standard deviation because I don't have it, but I'm guessing it's around about 100,000. Believable numbers skewed by London, of course, which is skewing those numbers to the upside. Otherwise, the standard deviation wouldn't be as large. That would leave about a quarter of people at 300,000 or more. The head of mortgages at Halifax cited resilience and noted that mortgage approvals and transactions have both picked up, which is true, as they've reported, and I've reported as well. And that more buyers are returning to the market. Wages are rising, easing affordability pressures. So someone else is noticing, at least. And Ms. Bryden also cites stabilising interest rates, giving people the confidence to plan ahead. Well, that's one interpretation, although it's hard to evidence without survey data or the likes. Now, the first quote pertaining to my roundup of a couple of weeks back. Over the last 2 months, we have helped. I don't know whether that's we as in Halifax alone or the entire group, the HBOS group, the Lloyds Banking Group. It's probably the latter because they publish their results as a group. So let's assume that it is. They've helped an additional 3,000 buyers over the last 2 months, including more than 1,000 first-timers, to access a mortgage they wouldn't have qualified for before. Now, this is a little bit anecdotal, but this is the best we've got at the moment until UK Finance or someone else does a proper report who has all of the data. Let's assume they mean Lloyds, Halifax and Bank of Scotland combined as a group. And let's assume that change, that 3,000 extra mortgages, is a representative change across the sector. My analysis a couple of weeks back certainly suggested that the amount that people could borrow moved up by around about 28,000 quid on average, and all the big banks were mentioned in that conversation. So, according to April figures, Lloyds Banking Group represents 16.8% of the market of new lending. If that's the case, then 3,000 over 2 months is actually 18,000 more mortgages than otherwise would have been written across the sector. 9,000 a month or 108,000 per year. Significant and increasing transactions by the tune of around 10% more transactions than we'd otherwise expect on its own, working on about 1.1 million transactions a year, which was roughly where we were last year. So that will put some upward pressure on pricing because of higher demand on this basis. But let's not forget there's more stock as well at the moment. So we can't run away here. But also, there's going to be a bottleneck, I think, of such people in the pipeline. It's almost always the way it works when something changes. So in the early days, we'd be expecting extra volume. But that could easily be an extra 100,000 mortgages in year one and then just start to dwindle down accordingly. We might have sort of 2 or 3 years working through the backlog or even more. This is houses that we're talking about, but 2 or 3 years would be a precedent. If you look back at something like Right to Buy, for example, in the 1980s, it took about 3 years for the absolute glut of volume to happen, and then it started to taper away a bit. So this is not as seismic as Right to Buy, of course, so I'm only speculating. But this potential kindling to the market, you could argue, has maybe been a little bit quashed this week when the lenders who'd asked for a change in the 15% flow limit cap. So just to recap, that's the percentage of new loans allowed to be at more than 4.5 times income, was poo-pooed by the Bank of England's Financial Policy Committee, who pointed out that as of Q1 2025, high loan-to-income lending was only 9.7% of new flow and was projected to rise to about 11% by the end of the year, leaving about 4% of headroom below the cap or 400 basis points. You have to go quite a long way to go from 11 to 15, let's face it. So their argument is it's not broken, so we're not fixing it ultimately. Or perhaps in the more typically conservative Bank of England style, we don't want a few rogue lenders potentially going above the 15% limit and creating a problem on their own and creating a systemic dependency or a landmine for the future. Sensible stuff, but not the fire under the mortgage market that Labour, in my opinion, secretly wanted. Now, lenders can originate more than 15% as high LTI loans as long as their overall lending flow stays within the 15% boundary. The FCA have actually issued another one of their explainers about this. So remember, they had a bit of an explainer earlier in the year saying, you guys have got the stress test rates too high, basically. And the banks responded and did what the regulator said. So what they're saying here is, by the sounds of it, you can average 15%. It's not just about new flow. That seems to be the clarification the FCA have put out. But I'll be following that and no doubt be recapping on that within the next few months anyway. I'm interpreting it as them looking at their whole lending book overall, but it's not actually clear in the report. So I used chart A from the FPC report this week to show you the data the Bank of England is working from when they look at the blockers stopping first-time buyers from buying a property. The big takeaway is 78% of first-time buyers are not buying because they don't have the deposit. And they refer to the 5% deposit, but there's a strange disconnect they're not discussing here because the average first-time buyer deposit is 21%, not 5%. But of course, they're dealing with the people at the tail. And of course, people are saying the deposit is the blocker because I suggest, apart from anything else, they will not even get to the next stage until they have the deposit. So once they've got the deposit, they'll then realise there's another blocker, potentially. 78% sounds really, really high to me. But the point is, this is the data that the Bank of England are working from. So bit of a segue, of course, but I hope you agree it was a worthwhile one. Back to Halifax, who also noted stretched affordability for those reaching the end of their cheaper 5-year fixed deals. Fair, and I've mentioned it before. And a softening job market not being the best for confidence when it comes to stretching into a new property for buyers, which also makes sense. But with the 2 further base rate cuts priced in by the markets, and true, I'm sticking with 1 for the moment, although the governor keeps coming out and saying things that are suggesting more and more cuts, so there may easily be 2 by the end of this year. The average drawn rate on mortgages is now at its lowest since 2023, which doesn't feel like that long ago, but it's actually a couple of years ago, of course. The drawn rate was actually incredibly low in February 2023 after the ship had steadied once Truss was gone but not forgotten and Sunak and Hunt had got things under control. Halifax are pointing to modest house price growth in the second half of the year, which is one of those nice words, isn't it, really? Because what does modest mean? Does it mean 0.5%, 1%? But it sounds pretty small. And for once, I'd be inclined to agree with them on the very near term because all the pointers are that ultimately we're going to see a flat few months, as I've been talking about. I would call that the characteristic of this market at the moment, flatness, realistically. But some of these newer, higher loan or lower stress test transactions are going to need to start to land. So they've helped in April, they've helped in May and June, the Halifax have said. So those are going to take a few months to land. They're going to start landing at the end of the summer when they actually complete, realistically. That's normally how long it's taking these days. So we might have a great Q4 in the housing market, but rarely do we have a great Q4 because now we're back to normal calendars and normal years, apart from anything else. What tends to happen is Christmas. So mid-November, it starts to quieten down anyway. So Q4 really is 6 or 7 weeks of trading. And, of course, by then, I've got to remind you, we'll have a budget, which is going to make a number of people nervous, probably more on the bank of mum and dad front, who might say to their children, look, let's just wait and see where things land in the budget. Because now we've suddenly, over the past sort of 24, 48 hours, started referring to people on modest incomes not paying more tax or similar. So are we sniffing yet one more manifesto breach? Friends, I suggest we may well be. 2026 market, though, could be a different story, especially if there is stalling due to the budget, because we could, once we've got that certainty of just how bad it is in October, November this year, we could go into 2026 with a bit of a fire lit underneath us for the first time in a few years. I'm just talking about the housing market there, not necessarily the economy, please note, although it will have absorbed much more of the April this year, NI shocks and all the rest of it. What other terrible things will be done to us? Let's find out together. So Nationwide and Halifax are in the book, but what about Zoopla and their most recent report? They reported sales agreed at the fastest rate in 4 years, which has to be a significant positive, but price growth falling to 1.4%, with 14% more homes for sale. They do note, as often being the most insightful of the major indices, that house prices are rising more quickly in affordable markets. Is this because this is where the investment money is going, where the stress tests and the debt service cover ratios actually still stack up for mortgage purposes, and there's a fighting chance of a cash flow profit, apart from anything else? They also note falling prices in markets with average values about or above 500k. For the same reason, I believe investment money is just leaving those markets. And also, I dare say, the buyers of those houses are not committing to moving or even staying in the UK. They're not committing to the UK necessarily, waiting for the next round of whatever you want to call them from the Chancellor in October, November. But Zoopla finishes with a conclusion after my own heart. Setting the right price is essential to achieving a sale. The average time to sell is 45 days, unchanged from a year ago, they say. They also see things as very flat month to month and make the same conclusion nationwide did. Flats are down 0.8% year on year, according to Zoopla, whereas terraces are up 2, semis up 2.5, and detached up 0.9. And of course, that's going to be somewhat explained by their higher average values as well in the context of what's already been said. But Zoopla now has, in the 4 weeks to the 16th of June, this was reported on, 8% more new supply than the time period before, but 7% more buyer demand. So this is comparing things to a year ago, right? 8% more supply, 7% more demand. Very much, very, very similar, therefore, to the early summer of 2024, where the market had picked up a bit, in fairness. But we know that the stock is high and that supply is just ahead of the demand. So in the face of it, it probably loosely stays like a buyer's market at a very macro level, but not in cheap investment-friendly stock, I'm afraid, folks. Zoopla takes a different position on rate cuts, saying they're unlikely in coming months. They're making a mistake here, though, citing current wage rises at 5%. The bank doesn't really care about those. They care about the expected wage rises over the coming year, which are at 3.5% to 4%, nearer to 3.5% as it goes, which the bank sees as completely palatable and very much steady state. And historically, 1.5% to 2% above the inflation target. Not that we'll be at 2% inflation that time next year, of course, but 1.5% to 2% above the inflation target is seen as very, very sustainable and nothing that would cause any kind of issue with wage price spirals and things like that. And don't forget, when you get a pay rise of 3.5%, let's say, even if you're a basic rate taxpayer, ultimately 28% of that is going back to the government. So you don't see that whole 3.5%, although you do see 3.5% or slightly less in your take-home pay because it's calculated the marginal rate. We're still decent odds on to cut rates in August, though, at the next Bank of England meeting, especially with the governor's chat from the past week. So they then do a bit of regional slicing in the Zoopla report, which I always enjoy. They put together London, the southeast and the southwest, and point out the stock of homes for sale is between 16 and 19% up in those areas. And the prices there, according to Zoopla, are up less than 0.5%. And then between the northeast and Yorkshire, including Scotland, the northwest and the West Mids, there are between 0.5% and 5.5% more homes for sale. So there's a big disparity in the supply here in terms of where things are coming up. And the price brackets are 2% to 3%. So big numbers for Zoopla, who are always quite low on their annual increases. Their data must be flawed by working too much from asking prices. Because ever since I've looked at Zoopla data, it's understated what comes back in the ONS figures. But anyway, how much are the markets with average prices of £500,000 plus falling by 0.2% year on year, according to Zoopla? So whilst 0.2% of 500 grand is still a meaningful amount of money, probably not to get excited just yet. And one last interesting tidbit, 22% of what Zoopla currently have listed has been on the market for the past 6 months or more. So as I said before, there are deals out there. Sure, some of those are stuck because they can't move unless they hit their price. But that's not all of them, right? And if they need price, how about negotiating on time terms? And so the creative deal is introduced. Before I move away from the indices, I've just got one more cheeky segue or two. S&P Global produces the Halifax Price Index, which I do respect a lot less than I respect the PMIs that S&P Global also produce. Although with the Halifax HPI, to be fair to S&P, they'll be restricted in their input data. And of course, it's 50% at least a marketing exercise. So maybe I shouldn't be so harsh on it. But there were two further S&P Global reports of interest in the past week. Firstly, the UK Business Outlook, which reported improved profit forecasts supporting slightly stronger hiring intentions at UK businesses. Overall, this report was mildly positive and contained sub-headlines like inflation expectations ease slightly but remain relatively high. It's just beautifully British stuff. Sluggardly upwards. Let's settle for that. There is mention of the slightly superior, comparatively, current position on tariffs compared to business confidence in other nations. Because remember, we're already sorted. And although we're not better off than we were before the tariffs were introduced, comparatively, we're much better off than a lot of the other countries, including the EU, right? So the S&P also produces a UK regional growth tracker for NatWest. More marketing stuff, realistically. They're busy bunnies, though, aren't they? But this cites the main drivers of regional growth as the east of England, the southwest, and London at the end of Q2, with output inflation easing regionally and jobs being created in, wait for it, Northern Ireland, of course. But there was a significant improvement on the Q1 report, which, of course, was leading up to that awful April national insurance rises and all the rest of it. So some significant regional activity in those three regions at least. And then all the other regions are bustling between about 49.5 and 51. So they're sort of, taking a bit more time to get going, but they're not going backwards, which is an important thing, of course. Far, far better than it did in Q1, if you can trust this as any sort of leading indicator. The change looks pretty similar to the PMIs, and I'd assume they use similar data, similar methodology, if not the same data, and just badged as a NatWest report. So that's probably my record number of segues in one of the macro sections, but more focused now, I promise. Otherwise, you're going to need 4+ coffees, and I'll never be able to let you go today. So the RICS Residential Market Survey is up next. Now, this is never a fluffy piece of production. And if anything, it leans to the bearish side. Pretty standard surveyor chat, realistically. So in another treacle-laden summary, here we get sales market activity appears to stabilise, with near-term expectations for sales volumes turning marginally positive. Woohoo! I'm sure you can't contain your excitement. But in seriousness, it's more of the same, and the flat summer with a budget on the river as a kicker to surely play out as described here. I'm on the same page as the masses, which always makes me feel a bit uncomfortable, but I'd argue I'm there for better and more well-researched reasons. And of course, it's easier to predict the next few months than it is to try and predict a year ahead or 3 or 5 years ahead. Buyer demand printed +3% compared to -22 last time out. Same old story here. Q2's the sweeping up for the stamp duty changes. Agreed sales were still negative, but -3%. Compared to -25 and -28 for the 2 months prior. Just a quick reminder, when we talk about percentages in the RICS report, what we're talking about is the number of surveyors who respond to the survey, the positives minus the negatives, with the on the fences being left out. So a reading of +50, for example, might well be 75% of the survey responding positively and 25% negatively. 75 minus 25 is 50. Just worth a little reminder, because they're not real percentages, although they insist on quoting them as percentages in the report, which is mathematically frustrating to those of us who care about integrity of data, apart from anything else. Next 12 months sales volumes expectations have come right down, +5% from +25 last time. So suddenly it's all changed in 1 month, but it won't get better over the next 12. As I say, never get too excited over 1 month's figures. But new sales instructions are still positive at +3%, and +16% report conducting even more market appraisals over the period compared to last year. This all leads to a print in prices of -7%, but as you'll likely know by now, this very much decomposes when you look at the regionals. You know the drill by now. The southeast, the east, and London are reporting a decline. The rest are reporting better fortunes, especially Northern Ireland, the northwest, and according to RICS, Scotland and the East Midlands as well. -10% see growth in the next 3 months, so they're very much on my sideways bus. +24% see prices moving upwards in the next 12. I would say some of those are far too bearish, realistically, because I think that's much more of a penalty kick. I would see that as a +70 myself, to be honest, if I was putting some odds on it, apart from anything else. Tenant demand was steady. Landlord instructions printing -21 as that trend just runs on and on and on. It's been going on for years. Plus 24% expect rents to be moving upwards in the coming 3 months. There's no rocket science in any of that, I don't think. September's always a buoyant month apart from anything else, and August as well for getting in for September. Moving swiftly on to growth then, as we need to spend a little time here in order to set up the deep dive correctly. We've gone back to milder May's figures here for the ONS growth report, underwhelming though they were. The expectation was 0.1% in the black. The PMI suggested, as I said at the time, that a sensible range was -0.1 to 0.1, and therefore that 0.1 was about the most hopeful. And sure enough, the print was -0.1. Now, our PMIs were much better for June. Not that it necessarily correlates exactly month to month by any stretch. It's the overall movement and the overall curve that's very close. But there's also revisions to consider, rather than just looking at the -0.1 in isolation, because that's what the mainstream media did, and that's what they do, of course. A miss of this magnitude, 0.2% from 0.1 to -0.1, is never pleasing to the markets in general, although lower growth would usually translate to lower bond yields. A little bit more on that later, but it's what the governor's been saying as well, but he's been talking about from an employment perspective. But the basic premise is that if all else is equal, the classic Economist caveat, lower growth means cutting rates towards the natural rate or towards a rate below the natural rate that might help to stimulate the economy. Cheaper money, people can borrow more easily, fuels the economy. That's the logic, right? Now, the detail and the devil, but not in that order. There was a large revision to March's figures of 0.2%. So March growth is now stated as 0.4 rather than 0.2. Now that's 0.4 we've lost since then, of course, -0.3 in April and -0.1 in May. Careless, I'm sure you'll agree. Now, somehow, because of the phrasing that the ONS uses, which I absolutely hate, that's showing a quarterly growth of 0.5% to May, even though we've got +0.4, -0.3, and -0.1. So you go figure. I think the ONS should explain this in much more detail, and they don't. Or there has to be a better way of letting the lay people know exactly why it looks like such a bunch of Swiss cheese when the real running quarterly total, as I've just said, basically sounds like zero. It had +4 on, and you've had 0.4 on, and you've had 0.4 off in the last 3 months. But now, a rarity. Services were up 0.1 in May, so we deviated significantly from that in the overall figure, but production was down 0.9 and construction was down 0.6. So those big numbers were enough to drag that positive from services into a negative. And to take a look at the index numbers, services put GDP up 0.07, construction put it down 0.04, and production took it down 0.12. So in total, it went down 0.09 or 0.1% to us lot when it's rounded. Now, this is even more confusing when you put our annual GDP rolling number into the mixer, which is now 0.7. So if we go back, we've basically got February at 0.5, March at 0.4, but the year at 0.7 because the rest of the year has been so rubbish. Pretty miserable. And of course, that year does include election stagnation, uncertainty, what happened around the budget and all the rest of it. So you might say, well, yeah, that sounds about right, actually, Adam, to be honest. But pretty miserable. But in line of exactly what the likes of I have forecasted for this year, whilst other unnamed insane organisations were expecting 2% under Labour and their growth policies. They seem too scared to even say the word at the moment because they're failing so badly on that front. But anyway, I'll throw NISA into the mixer, or more accurately, under the bus. I do talk about them monthly, usually in this segment. The National Institute for Economic and Social Research. They do some good work. They can't really be held accountable for the revision in the ONS figures. And does that therefore really make me right and them wrong? If the numbers were wrong in the first place, you could discuss that. But they're very bullish 0.3% Q2 growth predictions are stuck in the toilet at this time. They're still maintaining 0.2% growth for Q2, which at this point looks brave, since the best estimate for June's growth would be between 0 and 0.2 if we based it solely on the PMIs. So we know 2/3 of the quarter's data at -0.4, but we're forecasting 0.2 for the quarter, with the other month that's actually already happened with some survey data released. Now, sometimes I give up, or perhaps that's just why I do what I do. You decide, and we'll be reckoned with when June's growth figures are out next month in this segment. What's done well though in May? Well, information and communication alongside admin and support service activities. What's done badly? Financial insurance activities mostly, alongside professional, scientific, and technical. But I've said before, legal explains a lot of the latter. Those figures are all over the place thanks to the stamp duty changes. Another big growth area, 6.1% growth in 1 month in May 2025, as we recovered from the lull in awful April just after the deadline. In reality, people put a lot of consultants and temporary labour in March. They laid them all off in April. They had a few of them back in May. That's all that's happened, really. In construction in May, the specific changes were a fairly large decline in repair and maintenance, so 2.1% down. Turns out you don't fix the roof when the sun's shining, and an increase in new work of 0.6. We know from the construction PMIs this was an expected contraction, and the house building is currently holding up the suffering civils and commercial parts of the industry. Infrastructure new work continues to come in, though. In a way, only the ONS can. They explain the tiny revisions in April's data because that was last month, right? There was a tiny revision, not even 0. Not enough to change things by 0.1, right? But because they've also revised March, and that wasn't last month, even though it's a much more significant revision of 0.2%, they don't even comment on it. Go figure. And they say we need change at the top of UK statistics. There are no words. Well, no, of course there are, because it's about numbers, isn't it? Sorry, couldn't resist the dad joke there. So we grew, then we shrank. We went spectacularly sideways. To be honest, if we can absorb the October budget as easily as that, and that would be very naive, the real period over which that's absorbed is about 2 years, as the pros at the Bank of England tell me. That would actually be a great result. Still, business is going to be waiting again and again here for larger investment decisions, and I'll be reporting on their comments with complete frustration until late October. Just wait for those PMI reports rolling in, saying they can't do anything because they're worried about what the Chancellor's going to do. They're still semi-communicating what they're not going to do. And of course, they can't release the budget months before it happens. They can't. But it would be an idea for certain things, certainly to shore up businesses, unless they're going to raise business taxes again. The people will have to pay for the people, ultimately, is what it's going to come down to. But it's lackluster stuff. It's a bad time for the Chancellor. It's a testing time for the PM. So let's have a look at the gilts and the swaps then. Now, we didn't have the week we would have expected based on that data. Tariffs and the US yields dominated things too much, and the growth figures did not put the yields down as we would have expected. Now, this is a bearish sign on bonds and suggests actually rising yields over the coming weeks, not falling ones. So bearish because the bond price goes down and then the yield goes up. That's mathematically how it works, right? We opened the week on the 5-year at 3.982 and closed at 4.051% yield. Yahoo sucks. Thursday's close of 4.033 corresponded to a 5-year swap yield at the close of 3.673. So that 36 basis point discount is holding out. 1 month ago, 3.72. 1 year ago, 3.822. So the most convergence that I've really reported on in this segment. This is the stability that the mortgage house price indices have been referring to. A very, very slow decline in pay rates, indeed, at the 5-year level. That's, of course, only 1 week snapshot, so let's bear that in mind. But why did we get dragged up? Well, because of those tariffs spooking those US markets. Their yields rose, and so did ours. We're not in control of our own destiny, clearly. This is the rest of July for us. Until that deadline won't move, right? So August the 1st for that tariff extension, remember. So what will happen then to the 60 countries still in negotiation? Blech. And the longs, well, the 30 years opened the week at 5.343 and rose to 5.437 over the week, steepening that yield curve a tiny bit more than it already was. It's an uncomfortable roller coaster up towards 5.5%. The 52-week high on the 30 years is 5.675, which I just think is an incredible price. And north of 5.5 represents wonderful investment opportunities for pension funds, in my view. Why did the longs move that little bit more? Well, I'm so glad you asked the question. If we just tie the bow around this section first, the best price 5-year fixed limited company no fee I see at the moment is Paragon at 5.45%, which looks a fairly skinny margin, to be honest. But of course, they take deposits rather than having to rely on the swap market for their funds. So that is a cheaper and more profitable bank of money for them to rely on. Still, I think that's a fair rate, and I'd take that ASAP if I was you. I can borrow at the price that the UK has to pay each year on a 30-year debt obligation. The state of that. How can that be right? Well, that rate is only fixed for 5 years, of course, so it's not necessarily a fair analogy, but it's still interesting, isn't it? So, to the deep dive. We can't let a report like the OBR's one slide out this week and not put it under the microscope. In the middle of the week, we were delighted by a 152-pager from the OBR, an annual, or more recent, because the last one was September 24, actually, update of fiscal risks and sustainability. It's just been a magnificent example of the Overton window, the focus of the media, which reflects or sets and influences the general public, which in turn influences where the politicians focus their attention. And that's my take on it. You could argue at different times, different parts of the system have different influences on the Overton window, of course. I don't think, for example, this government certainly, and the last government, do enough to try and control the Overton window. But there we go. Let's just reset to ground zero and get back to basics with a very politics-like recap of the past 18 months, with some economics weaved in, of course. We went into 2024 doing better than expected on the economy, knowing an election was coming within the year. Jeremy Hunt's efforts in that year were mostly described by me at the time as a poison pill, stuffing up whoever got into power next. Labour were a penalty kick. They could have said all sorts of things, but in a moment of what was simply fear from being on the precipice of power, which they had not tasted for 14 years at the time, with 80% plus of the party having never done the job in government before, they chose lies and lack of sensibility over taking the opportunity to do something sensible or a good job. The Conservative route was very obvious. It was, in the end, even worse than expected, but the markets got their predictions roughly right. I believe the Conservatives were around about 30 seats fewer than what the spread betting companies were saying in the end, but that's within a tolerable level of prediction, let's face it. The lie spread into two parts. We will not raise taxes on working people. With frozen tax thresholds, for example, you can argue that the stealth tax is always there, and there was never any scope or intention to change those before you start on anything else. The actual manifesto wording, there will be no increases in income tax, VAT, national insurance or corporation tax. Even more undeniably already broken. Stupid. Ideological at best, but overall, just stupid. Now, zoom out. The tax burden. Yes, it's very bad, and the worst since rebuilding from World War II. But here's what every commentator gets wrong, in my view. COVID was very, very badly framed by the ruling party at the time. It was a 21st century war, a war against an invisible opponent. At times, the strength of said opponent was genuinely unknown. As that became more obvious, the handling of the entire matter was clunky at best. But however much waste there was in spending to combat it, there could be similar wasted spending in a wartime situation. There was always going to need to be a recovery period. Look at the difference between the UK between, say, 1945 and 1960 in the public attitude and then today. It's unbelievable. We carried on rationing for years after the war was over. Now, instead, because of gutless politicians on all sides making poor decisions, we don't even refer back to it. We genuinely wasted the crisis, apart from those who lined their pockets during it, telling their mates or their pub landlords about contracts when the system had some slack in it. Pathetic, embarrassing, but most of all, political mismanagement at the very highest level. This is part of the cancer of politics today. Instead of worrying what the people care about, instead of being a consumer of the Overton window, we lack the leadership that can actually shift the window itself. We've lost the ability to forge forward at the top of government of whatever colour. It's painful to watch. But back to the tax. The tax burden is bad, far too high in order to stimulate growth in itself. What this tax burden should be doing is dampening down inflation, which is not a bad thing at this time, but it does make it difficult to encourage growth. But you've got to take that tax and invest it. I've got no issue with taking more tax if you get it right, and you don't need to generate great returns even to beat 5.5% long bond yields. 7% would be fine. And there are many public sector projects that can return more than 7% IRR to the Treasury, even if we just stuck to housing and infrastructure. Well, let's dwell for a moment on income tax. There could be a nice pie chart here, but I prefer ready reckoners, as regulars will know. All the money comes from income tax, national insurance, VAT, and then to a lesser extent, corporation tax. We might as well forget the rest of the tax conversation. And as someone who's paid millions of pounds in stamp duty, and believe me, it's hurt, right? It's a pebble in the pond compared to tax that the country takes in from those four taxes. Now that will do us. It's four taxes, but it's badly named. An honest system would do the following: combine income tax and employee national insurance and call that real income tax, for example. And the levels could be like they are today: 0% to 12,570, 28% from 12,570 to 5270, 42% from 5270 to 150,000. Doesn't work like that because actually the personal allowance is being eroded away when you get to 100k, as some people will know. And then 47% from 150k upwards. That's PAYE for you. The basic rate, if you want to call it that, so that's adding together employee national insurance and income tax, is 28%. It's the one that the average person pays and the one that raises a lot of the money from a percentage perspective in income tax. Now, that rate has been between 31% and 33.25% since the year 2000. Part of the poison pill, a massive part, that Jeremy Hunt left behind was to cut employees' NI from 12 to 10 to 8 before the Conservatives got booted. Instead, at the time, we need to rebuild more than any of those other years, arguably apart from 2009, but I'd argue we're in a similar situation at the moment. We're at 28% instead. So instead of being between 31 and 33.25, where we've been for a quarter of a decade, we're at 28. And this time we can least afford it. This is utter madness. Only a political coward could not point that out and then scramble to get the money from elsewhere. It's ruining the system. The other thing that combining the taxes would do would be to bring non-working people who pay income tax, might be pensioners, and do you know what? It might be some of us who take income from multiple sources at levels that avoid employees' NI contributions, and make everyone subject to the same 28+% threshold. Now, I believe it should get back to 32% as quickly as possible, right? Personally, I'd do that over a 4-year period, 1% a year. So it did take a slice out of pay rises each year, but it didn't take all of it, right? Now, I might be being a bit idealistic here, but I'm not being ideological, right? Employers' NI could be renamed, something to do with pensions, infrastructure, and healthcare, right? It's a good tax on the larger organisations, the very big ones, because it's hard to avoid, whereas they use complex structures to avoid VAT and corporation tax, as many will know. So the use of IR35 stopped them from avoiding employers' national insurance, which has been a good thing, actually. At the top level, it's just a pretty crappy thing for small business. As usual, the little guy gets it in the face. Now, that would raise a lot more money. And benefits would come in other ways as well. Well, what other ways would we benefit? Well, it could fairly dramatically shift the yield curve downwards, especially on these longer dated bonds. Why would that happen? Well, because the books would actually have a fighting chance of balancing again. Long time coming, right? Everyone benefits, apart from the people with net savings. But even some of them would benefit because they buy goods and services from companies and people who are subject to paying higher interest rates than they need to at the moment, because we've got no decent long-term future economically. So what would my 1% rises raise? Well, it raise about 6.5 billion a year, but going upwards each year. So that's at least 26 billion raised by just going back to where we used to be. And wouldn't that be a lot more palatable than the employer national insurance rise that didn't raise that 25 billion, right? This is income tax. This is not being offset against other taxes elsewhere, right? That's ended up raising between 6 and 8 billion from the analysis that I've done, right? Now, that's not factored in any of the extra money from bringing the current non-PAYE income earners into the frame at 28 to 32% rather than the 20% they currently pay. Mutiny, they cry. Not in 2024, they wouldn't have done, though. The electorate would have swallowed it whole, in my opinion. It's solely fear from stopping them. Is it that easy today? Well, the first 1% basically pays for the welfare cuts that haven't happened. And that's exactly how a lot of the media would frame it. So that's not going to be an easy conversation if you did do it. But the Labour MPs can't hear of there being a problem, even if we've got double the number of disability or incapacity claims that there were just a few years ago. They've got no appetite to get to the root cause, and those headlines wouldn't look good. But then they'd be used to that by now, let's face it. So, don't get me wrong, this is not happening in this Parliament. There is just simply not the political courage to do it. Reform haven't got the guts to do it either. They'll rely on some nonsense about growing the economy by 5% a year, which has no precedent whatsoever and sounds exactly like what it is, a made-up figure that just sounds good, right? And that no respectable organisation will believe that because it won't happen. Instead, the October budget this year will just bring further speculation, fear, indecision and selling of assets, as she has to look to pensions, ISAs and council tax this time round if she's going to pretend to keep that manifesto soundbite alive. That manifesto soundbite has already been broken, bear in mind. But look, that likely concludes why I don't get into politics, for those who are kind enough to ask or suggest that I might be good at it. There's inherent proof there that I wouldn't be, but I can promise you one thing, I would have courage, because that is what the country needs. You'd hate me, and you might not like me already, but you'd hate me for good reasons. Be the Overton window. That's what I'd have on the wall in the office at number 10 or number 11. Anyway, back to reality. A 152-page report on fiscal risks and sustainability. It slid out in September 2024 with a whimper. It was limited to the Institute for Fiscal Studies for comment and Parliament, basically. It didn't even make the supplement at that time. A true yardstick, I'm sure you'd agree. But let's face it, we were all consumed by the budget that was coming and all that negative chat we had around budget and the fiscal position in September 2024 and the black hole. So we didn't look at this actual long-term massive black hole, the universe ender that is there for us before the end of this century in an economy as we currently operate it. And of course, things need to change. So we had that massive media coverage. There were stark headlines this past week about unsustainability, national debt, pensions, and net zero. So what's changed before September 24 and July 2025? Well, a sense that defence spending probably needs to increase, which is where we were in September 24, became a firm commitment to get it up by about 30 billion in shortish order, and much more than that in the next decade or two. Although I file those NATO promises under things that will never happen, if I'm honest with you. A failed tax rate, effectively, so far. I've talked before about how the 25 billion headline only raised about 6 to 8 billion, and it could be less if you blame more of the anemic growth since the announcement of it on that specific tax rise. The BBC are now publishing headlines from their top economist, Faisal Islam, saying that Rachel Reeves' autumn budget will see significant tax rises. That's not a headline from last year, but from last week. It's as mainstream as it gets. But let me qualify it. It's another bunch of wrong tax rises, whilst we fiddle to maintain the poison pill income tax rate of 28%. The people aren't helping either, although for that, once again, blame the government. Simply saving the difference, which is basically what's been happening, plus some more, means that consumption suffers. The government is making people save, as well, by offering up such poor leadership and direction. People save because they're concerned for the future. Take those concerns away, they'll consume, the economy will grow. Win, win, win. Okay, that's more than just setting the scene. It's also somewhat cathartic for me, so thanks for staying with it. Don't worry, we're not going to line by line the 154 pages. I'll let you enjoy the rest of your day in peace, relatively quickly from here. Relatively. Remember, this is written by the OBR and is supposed to be apolitical. They don't do a bad job of that, in fairness, unlike forecasting, for example, which they do a terrible job of. But where does the OBR context start then? Correctly, with the past 2 decades and with what we've had to deal with. They separate them into 3, although I see little point of that. The GFC or 2008, enough said, the pandemic, and then the energy crisis. Well, the pandemic was significantly responsible for the energy crisis, so I see no need to make that distinction personally. But I agree, in isolation, it was a large enough event with a huge debt cost to the state to warrant a special mention. So I do get it. These shocks have strained the public finances, which is another British award for understatement there. Since 2000, deficits have averaged just under 5% of GDP. A much more sustainable number, of course, is the actual GDP growth rate, which would come in, depending on who you listen to, at about one third of that, about 1.6, 1.7. Although I do think that's beatable. I think reform 5% growth is a pipe dream. Debt was 98.1% of GDP by March 2024, highest since the early 1960s, which you'll note was after the rebuild after World War II, not before. And public spending at pretty much 45% of GDP is its highest sustained level since the mid-1970s, where the combination of union power and ridiculous tax rates were busy ruining the economy. The OBR recognises future shocks will come. They will, of course, but if you take a heightened pandemic awareness and a much more robust and sensible financial system since 2008, both of which should be praised, but the latter more than the former, the government is terrible at prediction but pretty good at reaction if they have enough time. The OBR then lists shocks which should not be shocks at all because there's a list of them. Some have been known for many years. An ageing population. How is this a shock? It's just a dynamic, a big and serious one, but just a dynamic. Climate change, again, hardly a shock. And in spite of rhetoric like a climate emergency, it is very much that on a geological timescale, but it's going to take decades to continue to sort out and has been discussed for decades prior. Geopolitical tensions, yeah, a bit more shocky, sure. But the reliance on the economy on oil is far, far lower than genuine oil price shocks of the 1970s. And one thing Europe seems to have got the memo on, largely after recent events, is that they need to stick together. I've limited worries on this front in terms of first order consequences for the UK and being in actual meaningful wars. But as a taker, we're always subject to where we import our energy in physical form from. Those are shocks. They're just day-to-day business for the government that we could have been on top of for the past 25 years plus, but we haven't shown the political gumption to do so. The report writes of an unsustainable path. How bad is it, and how soon will all that happen? Well, this report looks at the next 50 years. Public spending up from 45% of GDP to over 60% on the current path, with revenues at 40% of GDP. This sees debt rising rapidly from the late 2030s up to 274% of GDP. A meaningless number. It's not even an attempt at an accurate forecast. But what does the cowardly politician hear here? The late 2030s. Not in my watch. Move on. Taking into account a reasonable number of shocks and pressures, all the OBR alternative scenarios see debt moving to over 300% of GDP. There does in reality need to be an average spending tightening per decade of 1.5% of GDP for each of the next 5 decades. So if you look at that, that's 0.15% of GDP per year. To not achieve that is frankly pathetic. But instead we have another 4 years planned out where that spending will increase instead, not decrease. So how are the big ways to fix this in the OBR's eyes? Limiting global temperature rises to less than 2 degrees rather than 3 degrees. The OBR says this will alleviate around 10% of the upward pressure on the debt to GDP ratio. I have to be honest, I detest this argument, right? It still positions the UK as someone who can make a real difference at the global level on climate change policy. It's just wrong-headed. We're takers of energy markets, right? We're takers of global policy with a very small amount of influence these days. Forget history, forget the past. This is reality. What we could do instead is enact any measurable net zero policies that have a net public benefit over a decent time horizon, such as the next 50 years. If the net cost is too high, and we know the sorts of numbers being mentioned here, although the cost you will have heard, 803 billion was this week's OBR number for net zero, is 2/3 actually lost fuel duty as it goes. The House of Lords recently summarised the cost as about 1.4 trillion, but a net public cost of 344 billion. Guess what I'd do? Pick one of the several ways to recover fuel duty. Could be road pricing, could be higher road taxes, could be taxes on charging points to be phased in, and plug the gap. But do the investments that created jobs and created value, rather than just heading towards an arbitrary target at all costs when we represent less than 1% of the world's emissions of carbon. You do not have to consider the economic loss of not doing anything. But we're not talking here about not doing anything. And that's the biggest mistake of the other side of the net zero debate. We're talking about a sensible fiscally conservative economic approach which will create more value, which will mean we still have a government and a system. The best approach for climate change, as I've said before, is for everyone to euthanize themselves. Does that make that a strategy worth discussion? Of course not. So let's have some common sense return to this debate. The OBR moves on to health next. Improving the health of the population could reduce the rise in debt by up to 40% of GDP. So I'm not sure what climate change came before that, unless it is a political agenda, of course, in this independent body. On that front, I'd look at and measure the success of the sugar tax on drinks and use a similar mechanism, or at least consider one, to push up the price of the ultra-processed nonsense that is the root cause of the obesity epidemic, and use the extra revenue to fund more awareness, subsidise some healthier alternatives, and in overall education. So big food, I'd be coming for you, right? Productivity is last but not least on the OBR's list of bullets here. Listen to this really carefully, every 0.1% increase in productivity over and above the forecasted increase, which is small, right, reduces the rise in the debt to GDP ratio by 25 percentage points. Yep, you read that right. Or should we not have the very smartest people in the country working on this? Should there not be a minister for productivity, and a proper one with a track record, ideally from the private sector? Of course there should be. Do you know who's responsible at the moment for productivity? Well, it's split between the Employment Rights Minister, who you won't have heard of, not going to bother telling you his name, the Secretary of State for Science, Innovation and Technology, Peter Kyle, who you might have heard of because he's had quite a bit of airtime, mostly because of AI, because he's got AI and R&D within his brief as well, obviously an important role, and then the Business Secretary, Johnny Reynolds, who has no business experience, as discussed many times before. How wrong-headed is this? I'm going to say it again. 0.1% increase in productivity reduces debt to GDP over the next 50 years by 25 percentage points. So a 1% increase over and above the forecast level completely wipes out the debt to GDP problem. What the fudge are we actually playing at the top level in this country? I'm not meaning to minimise the problem. It's a huge problem, which is exactly why you need the brightest and the best to be working on it. It dwarfs all other problems in its economic magnitude. It's worth noting at this point that this is based on last year's output from the OBR. This isn't even including a single thing that this government has done as yet. This is the path left by the last government. That's really only a political point scoring note, though, because this path has not improved over the past year, in my opinion, and it won't with the lack of political guts that I've been talking about today and over recent weeks. The report then goes into further detail about these three areas in the completely wrong-headed order in which they've been placed. Climate change. In the predictions here, as I've said, the major loss is in the fuel duty. It needs replacing. It also includes carbon tax revenues growing significantly, which will be a drag. It really graphs a set of taxes which currently sit on those who buy fuel and moving them across to those who actually contribute the carbon taxes or emit the carbon. So more for the business, less for the consumer, unless there's any courage in all of that. The OBR talks a bit about the ingredient of why climate change hurts GDP, reduces labour supply, increases morbidity and mortality. That sounds like a bit of an assumption to me, which requires justification specifically for the UK. I don't doubt that it does worldwide, but at the moment, there are currently 75 times more excess deaths due to cold than heat in the UK. And it isn't just about heat, which is why I hate the phrase global warming, right? A lot of it's actually about rainfall and wetness, aside from anything else, as I've said before. But I really think you need some hard data there to make that statement in a report like this. It's also about reducing agricultural output and increasing energy costs. But I thought energy would be getting cheaper as it was renewable. Anyway, it sounds like logic that a truck could be driven through, to be honest, but this is absolutely classic. Who's watching the watchers? Who scrutinises the OBR here? Who's challenging them and holding them to account? They assume 3% lower GDP under an under 2 degree scenario. Remember, we're talking about the temperature by the end of the century globally. And they assume a 5% lower GDP in an under 3 degree scenario. I really don't like this whole approach at all, because apart from anything else, we're talking global, global, global. What we should be talking about is how is the climate of the UK changing and how is that changing the economy of the United Kingdom? We don't seem to care enough about ourselves, and we're still seeing ourselves as some kind of global policeman in this area, which is just insanity, right? Now, they cite some considerable uncertainty. Well, if they've got all this considerable uncertainty, why is it point number one on their three-pronged summary? Not political, my ear. Yes, they are citing credible studies, but I don't see an effort to take the baseline across the board. I also don't see them mentioning the 99% lack of control the UK has on the rest of global emissions. And the fact that we're a tiny influencer these days, especially outside of the EU, whenever there's a conflict, just not that bloody important anymore, folks, I'm afraid. And the fact that there are two more points that following that are much more significant from an economic perspective. So, as you can probably tell, the economic side of climate change tires me out, to say the least. They then go on to list these terrible extra costs. And this is actually a serious part of the executive summary of this report. Less than £1 billion, citing things like 0.009% of GDP and 0.006% on extra flood defences. I just can't get my breath. I can't give this any more airtime. This results in an increase of 23 to 33% of the debt to GDP at the end of the 50-year forecast, right, or the 50-year speculation period, I should probably call it. Or 0.1% increase in productivity pays for all of it. Seriously, this is one of the least objective pieces of reporting and one of the most disgusting pieces of prioritisation, or lack of it, that I've ever seen in a report that is supposed to be commenting on fiscal risks. Okay, health. Let's see how we get on here, especially considering our current pathway is to be a national health service with an economy bolted onto the side, with spending being at £250 billion a year by the end of the decade. Health spending dwarfs all else. What's the summary once again? Life expectancy is down by 1 year over the past decade. Fantastic news for pensions, but flippancy aside, an end to improvements in life expectancy. I think controlling for the pandemic would be important here as a more genuine aside. The real problem, though, is the gap which is widening between healthy life expectancy and total life expectancy. Because when we're unhealthy, we cost more than we contribute, or we're the route for doing so. The second-order consequences of missing early cancer intervention, for example, were discussed by myself and others at the time of the pandemic when services were restricted or disrupted. But the zoom out here. In the past 30 years, UK total health expenditure has gone from below 6 to over 11% of GDP. We're now above the advanced economy median. The forecast shows real public health spending, that's after inflation, growing at 3.1% over the next 50 years. Well above any growth forecast, of course, so it just eats our growth like Pac-Man. Now, interestingly, demographic factors and the ageing population are only driving 0.6 of the 3.1. So there's 2.5% there of other reasons for this. Health costs rise sharply at 65 out of interest, but that varies drastically based on income, of course, which is also interesting. The set of calculations is much, much more robust than the climate change calculations, which are completely opaque. Now, I'll stop moaning about those in a minute. Well, will I really? But I'm really stunned as the way this has not been reported on, even in fringe publications, or those who are genuine climate change skeptics. They've got some fantastic fuel here to really make a meal out of it, but maybe I'm just not listening to the right podcasts. But anyway, back to health, or the lack thereof. The assumptions are that public health spending will rise to 14.5% of GDP over the coming 50 years. So what about the implications? Well, healthier people are more likely to be employed, earn more, and live longer. Better and worse health scenarios in this forecast either lower the deficit by 2.1% of GDP or worsen it by 2.3% of GDP. So we've got a range of 4.4 between those two. Then the brutal bits, where with better health, pension spending is up 0.6% of GDP in mitigation. In a worse scenario, it's down 0.6, but that's almost entirely mitigated by working age welfare spending. In the better scenario, that's down 0.5%, and it reverses in the worst scenario. This is all about the participation rate, right? Inactivity, which I talk about all the time in the monthly employment figures discussion, being 1.5% up or down, depending on which scenario we're talking about. My real income tax, or income tax plus NI, as I'm going to call it from now on, rises 0.4% in the better scenario, where more people are healthier and working longer, and it drops 0.4% in the worst scenario. Other taxes are up 0.5% of GDP in the better scenario and down 0.6% in the worst scenario. You get the message, right? The actual economy is 0.3% smaller in the better scenario because that's the perversity of GDP. You don't need to spend as much money on healthcare. So the economy is actually smaller, right? But overall, you can see a big net positive benefit to the economy. Why is this not number one on the agenda, right? Make Dr. Chris Van Tullochen the Minister for Food and get on with it. I'm sure he could sort it. Now, I hope you understand that's a bit of a flippant remark, but it wouldn't be the worst place to start, would it? Jamie Oliver might get his hat in the ring as well. On to the impact. 44% lower debt to GDP in the better health scenario. 49% worse in the worse scenario. 10 times the range difference compared to the climate change scenario. 10 times. Ridiculous. How about the overall fiscal long-term projections? This is going to bring us to a close, this section, right? Population from 68 million in 2022, which shows how confident we are in measuring it. We're using a 2022 figure and a 2025 report, going to 82 million in 2074. Birth rate 1.59 compares to the replacement rate of 2.1. In 2022, 129,000 net migration was assumed. So that's when they did this same report 3 years ago. They assumed 129,000 net migration. Why, I don't know. They're now using the ONS steady state figures of 315,000 per year, which is supposed to be the 2028-29. Will we get there? We'll see, won't we? I'd suspect more like 400, 450,000 myself. Perhaps we just gloss over what the recent numbers have been, but they do make the point that if the net migration was zero, the population would gradually decline to 60 million by 2024. And of course, this is part of the inherent problem. What we'll be left with is a bunch of old people not working who'd all be moaning about no one because they can't moan about the migrants anymore. So it is a difficult scenario and can't work out with no one to look after them because no one wants the social care and the NHS jobs unless they're a doctor. But how does the makeup of that population change? Over 65s go from 19% to 27%. So the already unsustainable triple lock gets even more difficult to change because more of them are around and more of them will vote, right? This is getting more depressing, isn't it? The really strong growth is in the very oldest groups, 85 plus. That growing share of the population comes from fewer under 16s. So 25% in 1974, under 16, 20% in 2024, 15% by 2074. And 16 to 54s, 50% in 1974, 49% in 2024, so hardly any change, and 45% in 2074. That's your working age population, folks, pretty much, or certainly your earlier working age population. 6% of the population will be over 85. That's 2% today and 1% in 1974. Then there's a load of scary graphs. But for me, exactly what we should be using in concert with a whole suite of non-economic measures when discussing migration. At what ages are we net fiscal contributors as a whole? Right, it won't surprise you. This is done decade to decade, right? But it's 20 to 69. From a brutal economic perspective, at least the children, who are obviously net detractors of the fiscal system, stay and then start to contribute tax. So their first 20 years is economically worthwhile compared to their next 50. Now, the net cost of those over 80 is humongous. And the population shape change is the very largest challenge we are facing in this 50-year period. In spite of the ordering of priority in this report, it's about 50 times more important than climate change in terms of what the UK can actually do about it, of course. The pension spending goes from 5.2 to 7.9% of GDP under the triple lock and this demographic trend. They don't break down which one changes which in the report, unfortunately, but there we go. So the result of all this combined, net interest spending, so what are we spending on actually servicing the interest payments, moves from 2.8 to 11.3% of GDP as the stock of debt rises. No, no, no. This just cannot be allowed to happen. Today's gilt rates are 0.2% above the assumed long-run growth rate of nominal GDP. Now, this is rarely used, remember, because we always talk about GDP as real GDP adjusted for inflation. But this is non-adjusted. But that 0.2% premium is extremely damaging, and something needs to be done about it. Ideally, something that could actually bring the rates down, right? Apart from anything else. The smoking ban costs 0.3% of GDP. I probably detested this policy more than anything else Sunak did. I don't smoke. I hate smoking, right? But if you want to smoke, smoke. Just don't do it near me. Same for any of your vices. All we should do is attempt to capture that cost correctly and use it as a government for doing some good and mitigating the cost of such things. It costs 0.2% of GDP per year. Tax it to 0.4 then. But for goodness sakes, let people make their choices. You can probably tell where I stand on the drugs debate in general as well. But this conclusion is exactly why there's been so much fuss here. There are three big problems here. One is much smaller than the others, and the only one we're doing something about from an economic perspective. We are ignoring the other two because our leaders are just too cowardly to address them. That really rouses the spirits inside me, as you can probably tell. And I'm looking forward to using the small voice in my little corner of the internet to fight against cowardice in leadership going forwards and calling out wherever I see it. So who wants to fund my campaign? No one, because you'd be paying more income tax. Well, that's an assumption, but I'd rather not make assumptions. That goes on far too much in these decisions that are worth billions of pounds. But you can likely take a step back and realise a realist like me is unelectable, even if I was deemed to have a good handle on some of the potential answers. The OBR assumes a recession or an equivalent shock every 9 years, because that's generally been the pathway of these things, right? And those move the path of debt to GDP above 300%, basically adding another 50% to the debt over the period. Another good reason to fix the roof while the sun is shining, but also to frame the most recent shock, the pandemic, or you can do it as the pandemic plus the energy crisis, as the sizable one or ones that they were, right? There are some other scenarios explored as well, which are interesting. Short stay migration, 50% leave after 3 years, saves 23% of debt to GDP due to lower welfare and state pension spending. Higher earning migrants, which we've tried but with the wrong policies, would lower debt to GDP by 40% of GDP at the end of the period. It's still unsustainable changing these things alone, but they do make a lot of sense. Productivity-wise, if the public sector was increasing instead of decreasing in productivity, we would see debt down to 65% of GDP rather than 274% of GDP. Yep, stop for a moment. Blowing away even the significant changes in scenarios in the rest of the report. All in on productivity, please. That would be higher productivity, but not increasing spending by the same amount, just with the nominal growth in earnings in line with inflation or similar. If we did what we usually do, if we had the productivity growth, it would still be worth a 6,000 basis point haircut from 274% of GDP, debt to GDP, to 214. Not enough, but still a massive improvement. We need to tighten slightly, but send much better signals to the bond markets. I am bereft at how obvious this is and how little this is understood by the people in the jobs at number 10 and especially number 11. It's a tragedy, to be honest, but instead we'll have our eyes on the next budget and I'll pipe down and buy a ton of stock, just like I did in the run up to the last budget, at great prices. Some of you might be spurred into action by my rousing words of hope on house prices in coming years and a market with rising rents. Or you'll just do what you were going to do anyway. You know what I'll end by saying anyway. But before I do close, don't forget to book those super early bird tickets to the next property business workshop that Rod and I will be running on Wednesday, the 1st of October in central London. This time around, investment metrics and how to run your property business at scale. My favourite topic of all. Book at bit.ly/PBWEIGHT. But above all, please remember to keep calm, always listen to the supplement and carry on. There will be opportunities abound this year and towards 2030 and towards 2074, and the risks at this time, while they feel significant, especially the geopolitical ones, are far less meaningful to the UK housing market than they have been for several years. Of that, I have no doubt. Prices are on the up in the medium term. Good luck. Thanks for tuning in, folks.